There we go. Right, we are back in business now. Right, we're going to cover the risk on, risk off exercise. Be interested if anyone did have a go at it, what they think the cause of the action was. I'll also show you how it traded as well. Then I'll do a little bit on bond and curve correlations, relationships, which might possibly open up more questions than it answers. But I think that might be something that we can explore or answer as we move into next week. So it could end up being a subject to a fair few questions on or tomorrow. Right, so let's go for it. This is the whole one of having a go at that trade. I put the current narrative, it's always helpful to know that, but at the time, the whole narrative was around tariffs. Is America, or more to the point, Trump going to put tariffs on anybody, and what's the impact of them? And then the quite simple trade that you had almost all the time throughout 2018, 2019 was the yes or no on tariffs. Yes tariffs, bad news, no tariffs, good news. This was the one in May. Did anyone have a go at it and have a thought?
Set up my replay.
Weren't having it.
He wasn't having it.
I did worry about that. Well, I'll show you charts of what happened. I put a few charts up for you guys to have a look at in order to sort of try and plan out where you might want to execute. Main move was a DAX one on this one. It's always helpful when you have a market that puts in a nice steady grind down and then you get news the other way because it gives you a nice big move towards the upside. So we had a DAX one, we had S&P. I then also got this was the result of it. So from the results, or if you had a go at it, so I'll explain it now anyway. If you had a go at it, I was hoping that people worked out this was a European related tariff trade, not a Chinese one. You'll see when I show you the execution of it, how people go about executing on these things. You'll see why I say it like that in just a moment. The trade itself was, there had been a threat of tariffs on Europe. The standard, Trump's going to put 20% tariffs on Europe. There was then the news that they are going to delay the tariffs. So as soon as he says delay tariffs, take that to mean no tariffs, and you then get this big move. The DAX is obviously the place to be. I still think that will be the case. Anything that comes towards Europe, you're going to see that type of thing coming through, that the DAX is the place to go, on the basis that it's probably going to be cars as the main thing. The reason for not Euro stocks is quite heavily made up of European banks. It's quite hard for America to put tariffs on banks. They don't exactly export a thing. And most people in America use American banks anyway, in the same way that most people in Europe use European UK banks. So it's a harder thing to put a tariff on, whereas Germany exports a lot of stuff. Of all the countries in Europe, Germany's a big exporter. Cars, chemical goods, there's all sorts of stuff they export. So tariffs are going to hurt Germany more than they're going to hurt anybody else in Europe. So the DAX is the place to be on that. Hopefully, it makes it a nice market once again. This is the S&P move. What's quite interesting about the two, and this, again, another sort of correlation type thing. The DAX on the move initially, so this is 3 minutes, the DAX goes straight line up and peaks up there. That is around about 1925, 1215. So DAX does about 200 ticks in about 3 minutes. Pretty hefty move. But after that, it then stabilizes and doesn't do a great deal else. The S&P, on the other hand, goes nowhere near as far in the first bit of the move. That does around about 20 or 16, 17 handles, but then continues onwards for the rest of the day and does another 25 on top of that. The whole idea here is, and this is something to sort of think about from a correlation perspective, the DAX at the time is trading around about 5 times higher than the S&P. Sorry, 4 times higher. Trading around about 4 times higher. So if the DAX does 200 ticks, the S&P theoretically should do about 50. Obviously, this is more DAX related than S&P. So the DAX does 200 and then pulls back. It still holds up pretty high, so it's still up 150. So the equivalent there should be about 40 or so in the S&P. On the initial move, you don't get everyone piling into the S&P, everyone dives into the DAX. So the S&P jumps, but then it catches up that relationship between the two over the rest of the day, which is why the DAX jumps and stabilizes and the S&P jumps and then grinds onwards. So that's also something just to bear in mind in terms of these sort of relationships. I find that correlations they don't always move perfectly in line. You get this kind of dislocation and then realignment. Yeah, that's probably the best phrase for it. I'll show you the execution on this. The main thing on this one is, and I'll point out different markers. What you've got over here is pretty much all over here. S&P, DAX, copper, Bund. Bund's a general go-to on a lot of these, just as a risk-off type trade. And then it's quite typically, most people quite like the Bund because it's liquid and it will move a bit. So it's a reasonably good one to go for on a lot of these sort of data points. But there you go, you've got the DAX, S&P, copper, Aussie. It's the way that everyone's going to start doing it, and you'll start getting people having them lined up like that. S&P, copper, Aussie in particular, and then probably DAX as well will start to become the sort of order that a lot of people have their markets set up as. I'll play this one from here. What you'll get, well, the news comes out here, no or delay to tariffs. So the first default on these situations has always been hit the S&P, but you then see that rather than trade the DAX, or at least not instantly, I'll take it back a little bit. Take it back to there. So news comes out. If you watch then the order in which stuff gets traded, it's already in an S&P position instantly. So if you watch the order that the little blue boxes pop up, it goes S&P, then copper, then DAX. And the reason being that most of the tariff comments of late, or at the time, were generally Chinese related. So the default was, if it's tariffs, if you see tariffs delayed, you don't look and think, oh, maybe it's Europe. You just go default S&P, less tariffs, buy copper, because that was the go-to place at the time. So it's then hit S&P. As soon as you start to go on side, and this is the other part of the strategy on a lot of these types of correlation trades, you tick on side S&P, then you hit something else after that. So once you can kind of go, yeah, I'm on side, I'm in an all right position, then you hit something else, which is the copper. Then there's a realization to go and hit the DAX. The DAX incidentally had started off at around about 25, so it's already up 50 ticks at this point, which is a reasonable distance. So you hit copper, and then it's only then once the DAX starts getting up towards the highs that you start to go for the DAX. So it's bought the DAX finally, but at this point you're buying it up here, having started down here, so it's done that move, and then you're buying it to try and break the highs. So you're looking for the next sort of 50 ticks on that one. You also realise that it's a DAX related story now, so you need to be in the DAX more so than anything else. The thing that you get in last, you naturally have the worst prices in, that's the one to manage the most. So that's where a lot of the focus goes. It's gone from 30 to 60 lots and then scaled those down quite quickly. You're always at the risk the later you get in that you are basically chasing and getting the top of the move. So whilst it is much more European related, you run the risk that the DAX could turn and people profit take on it.
Plus, I guess also in news rate stuff, you've got no, because of the fact you're just using ladder and the time factor, you've got no visibility of real market structure, right? If the price moves 100 ticks in DAX, you don't know whether that's blown through significant LVNs or any existing, right? You just don't know that, so you're therefore just having to manage it on just purely what you're seeing on.
Yeah, absolutely. This is where most of the time you're going to get up. Luckily on this day, you've got it selling off, so it's quite an easy one to go, well, if it's sold off like this, break through the levels, and that acts as your next level of support. So where it is now, that's the high of the day up here, and then you've got the gap up here and then gap higher up there. So they then become your targets. But yeah, you're almost purely going like, as if this is totally new, you've not traded these prices before, and just using any points on the ladder to go in, or get out, however you want to look at it. That's another one of, it's shot up and he's tried to fade it, which again has not worked particularly well. So they've tried to fade it for about here, or possibly that previous level there, and then it's jumped to the next bit up. Again, same kind of strategy, it pings offside. If you would sell it and you're already in, it's probably still worth it, but just be very aware that your whole objective now is just to get out and not make the situation worse, rather than this be a way of making money, which he does finally manage to get it on side. Incidentally, the copper was probably the thing that got left the most. It was almost a case of, well, it's gone on side, leave it be, deal with the other stuff. Copper's that little bit less volatile as well, so it's a bit of an easier one to go, well, I stay in that. But that's very much your kind of what I call smash and grab type trade. Straight in, move, straight out, job done. Oh, excuse me, sorry, a little itch on my leg.
It's not a big contract, copper, is it? Basic?
12.50. Well, 12.50 for a small tick, so yeah, 25 for a big one. So yeah, it's quite a decent sized contract. It's just not, it's not super volatile. What copper does have though is around about 9 o'clock every morning, they have I think it's the Chinese copper warrants, so you can trade that like a close. That became quite a big trade at the beginning of this year, of just trading copper at like 9 o'clock in the morning. You get quite a clean move, like between 9 and 9:30. There you go. I would expect we're going to see a lot more of that over the next year or so, these types of trades, you know, whether it's copper, Aussie, S&P, DAX. Possibly one of the things that, well, people have started to trade more, I don't think we had access to it previously, was HSI, Hang Seng. So that's going to be a really obvious one on any kind of China tariffs. So for those who've got that, that's going to become a trade, you know, basically just in your line of other correlated markets, those four plus HSI. Right. You got the same kind of thing. Well, you got a move in the Bund, but being as it was already very strong on the day, the Bund doesn't do a great deal and then bounces back. You wouldn't be massively surprised by that. The thing with the bonds on these types of things, they react as a kind of risk on, risk off correlation, but very quickly give it up on the basis that, well, it's ultimately not changing a great deal from a bond perspective. Right. Next thing I was going to do was a little bit on rates. And the relationship, I got here, relationship between gold and bonds. Because again, the general kind of idea is that gold and bonds will correlate very nicely, which on the whole, they do. So remember, this is yield. Oops, I use red. So that's your yield on a 10. So you get COVID, this was the whole bonds drop and equities drop scenario, where you'd got, not bonds, gold. Gold rallies initially in COVID, then gets hammered at the same time as the 10-year. For me, gold is more sensitive, I think, to stimulus than it is to almost anything else. You saw this post COVID, once the yield starts to drop back, i.e. stimulus comes in, they start buying bonds, 10 years drop, yields drop. That was then the beginning of the big rally in gold and this rush towards buying gold as essentially somewhere to put your money. So I've always viewed it as I know a lot of people view this as a hedge on inflation. It's a very early hedge on inflation to call this in July 2020. I have heard people suggest this about the recent gold move as well though, that it is or was a preemptive hedge on inflation, which if true, does kind of stack up with what happened here, because really inflation only became a story around here at the beginning of 2021, at which point then you start to see the bond yields rallying or starting to bid up. You still got QE going on, so QE is not going away, but people start selling off the bonds at the beginning of 2021 on the basis that the economy is improving, inflation could be coming back, and then you start getting gold selling off as well. So I've always felt more inclined to go with gold follows stimulus than it does necessarily inflation. It's a very similar story in 2008-9. Gold didn't really start rallying until sort of 2009 and then peaked in about 2011, not mid-2008 at the sort of peak of the crisis. In fact, I think gold traded from about 900 in 2008 down to 600 in 2009 and then up to 1800. Same kind of thing here. So they don't correlate all that well, I don't think, on the whole. This period, you've got gold selling off, you have got bonds selling off in this period, so that stacked up reasonably well. But the exaggerated buying of bonds here, buying of gold here, to me seems to be more a stimulus thing than anything else. At the end of the day, you're trying to buy something that's going to give you a return. At that point of time, you've got yields that are offering you very little, equities that were not performing particularly well. They bounced since April, but were then starting to stagnate. So then you start getting everyone buying bonds. Right, this was one that we saw recently, and again, final thing on sort of equity bond correlation for now. This was the August payrolls here. And to the point that we were talking about earlier about the reaction on data, this was then quite a significant one because you saw a change from what we had been seeing, where it was generally bad data equals rate cut, therefore it is a buy for bonds and a buy for equities. This one didn't go like that. This one then flipped. So I think this is beginning to sort of show up as the theme that the rate policy is somewhat less significant now. It came back, but what you got was on the payrolls, you got equities sell off, bonds rally. That's just a straightforward risk off type scenario. There is bad news out there. The economy is not looking good. Sell equities, buy bonds. It also, and this is where I always think that bonds are a little bit more straightforward on data. Bonds rally if you believe rates are going to get cut. Bonds rally if you believe the economy is in trouble. Equities previously rallied on bad data on the basis that rates are going to get cut. Now it seems that they don't, on the idea that the economy is in trouble. So they're very much subjective to the situation, yeah. So you've got a little bit more sort of uncertainty with equities. What you then got though was in the weeks after, the equities go back up. The treasuries stay up and the equities reverse it, which is essentially and I think this is two parts to this. One, it's a bull market, this is a chance to buy, and two, rates probably are going to go down. So that rate play is still there, but there seems to be more weight on the idea of deterioration of the economy as a bad thing now, whereas previously any deterioration was just, yes, but we're going to get the rate cuts coming through. So that's potentially become the situation. I think we've not really seen any particularly bad economy news recently. And you know, on the flip of that, you could also look at it as Trump coming in has been pretty good for the economy, or at least is perceived to be, and you're getting this straightforward risk on, risk off type scenario. Right. I was going to do this one, but I'll leave this one for now. It was, the idea behind it was an illustration of using the way a market moves to assume a correlation. So the whole idea behind this one, if you want to go and have a go at it, is the 8th of June 2021, and it was 11:14. The whole idea of this one was that the initial news was that you had an internet outage across multiple websites brought upon by Fastly. No one got any idea what Fastly is, and come to learn that Fastly runs a lot of the back end of big companies like Amazon and the NHS and Apple, etc. I know the NHS is not economy driving, but major companies potentially are not going to be able to operate. So what happens is, in the first instance, it just plays like a risk-off move. You get the equities drop, bonds rally, yen rallies. Yen's generally seen as a safety play. All of those things move, and then you get the realization. So with a lot of these types of trades, what you've got to think about is what's actually getting priced in to start with. The first stage is price in uncertainty. You don't know what's going on, therefore just play it as a straight risk on, risk off trade, or risk off in this situation. The next part of it, and this is where you get the idea and partly the reason to go and hit multiple markets, is you know there's some uncertainty, hit the equities, hit the bonds, hit yen or gold, whichever you choose. Then you work out what exactly the story is and what the potential of this is. If, as it transpired, and you did a bit of research and worked out that this could mean companies are not going to be able to operate potentially for days if this doesn't get sorted, this is really bad for the S&P and for NASDAQ. It's not really that much of a mover for bonds. As long as government pays their debts when they need to, it doesn't really affect anything that major or that significantly. It does have to get priced into the equities though. So you can sort of, by jumping in and then assessing the situation, you can work out what you stay in and what you don't, where you should be or where you shouldn't. There's then also the idea of resolution in terms of, well, what is the solution to this and how quick could it come? So the bonds, gold, yen will fade out of this quite quickly, so it just becomes a short equity play. There is an element of it's worth just staying in these trades, because until you get any sense of a resolution, everything remains shut, and the longer things remain shut, the more worried people are going to get that there's going to be no solution to this anytime soon. The only major risk you've got here is that you then get the exchanges shut. So that's something to consider in a situation like this, because if the exchange shuts, the problem gets sorted. By the time they reopen, your position is going to gap back against you. So that's the one thing to consider if you do get anything, you know, of this type. It's always something with any kind of real uncertainty, just to make sure you sort of think, well, is there a risk of an exchange shutting?
We had that with the CrowdStrike incident earlier in the summer. So CrowdStrike is cybersecurity software.
Right.
It's heavily integrated with Windows. It ran an update that basically blocked or bricked a lot of Windows servers across most organisations, including a former employer of mine.
Right.
And there was a frantic effort, non-stop for 72 hours, to make sure that didn't impact the market's ability to open. And that was across the globe.
There you go. Yeah, exactly. You could end up with something like that.
Yeah.
And if that happens in the middle of the day, the risk you have then is, yes, this looks like a wonderful idea, but you want to be sure you can get out. And if,
Especially by the end of Friday, because if it fixed over the weekend, then massive move Monday morning.
yeah, precisely. Particularly as everyone's short, so everyone's going to try and get out, and you could be in real trouble. So worth thinking about. But this is the basis of it. It was a very, very minimal move as well. So it's something, if you do go and have a go at it, it's very, very minimal. But you do see this just generalized sort of correlation across the board. But very, very quickly, everything gives it up. Gold a little bit less so, but gold only does 36 and just sits there. So it gives it a little bit of a boost and then does nothing. Bonds roll over very, very quickly. It's the equities that go and stay down. As soon as you get the resolution, and this is the other part of it, once you know what the news is, and with something like this, you know that there is a solution out there and you know what it is, you've then got the counter trade as well. Solution announced, you've got a trade on that as well. So it's always quite a nice one to be in because you're in, you're short, you wait. You know that at some point, not only are you going to get told to get out of your shorts, you're also going to get told to go long as well and play that move straight back. So quite a nice one to play. Right. I will try and make sure that I can keep in track of what's going on for this bit. Right, bonds. Not always the easiest thing. Probably the easiest way to look at any of these things is to look at the difference between 2-year and 10-year. That's the most straightforward. So in terms of reference to short end and long end, short end I would suggest 2-year, long end I would suggest 10-year. The general sort of split between the two is 2-year relates to rates, 10-year relates to growth / inflation economy. So sort of view it as the economy as a whole. Perhaps an easy way of trying to think about this is also as an asset switch idea, that the 10-year is your alternative to owning stocks. So if you don't want to own stocks, you buy 10-year bonds. If you don't want to own bonds, you buy stocks. So that sort of gives you that economy version of the long end of the curve. Whereas the short end is rate related. So often you end up with a situation, if the short end does correlate with stocks, often it's in the same direction, as in lower rates, short end bids up, that drags stocks with it. Higher rate, short end drops, that drags stocks with it. So you get a little bit more relation or sort of correlation short end to stocks when the short end's moving. If it's not moving dramatically or on a day by day reactive basis, the short end generally doesn't get attention. I remember probably 2021 before I ever really paid any attention to the short end or to a curve full stop. It was just never really a thing to talk about. It was always, if you're going to look at bonds and US ones, look at T-notes, and if you're going to look at European bonds, look at bunds. Don't worry about the rest of it. Once it becomes much more rate related, then the short end starts to come in. So the short end has its times, but it also has long periods of being an absolute dead market and nothing goes on. If it's clear what's going to happen with rates, you don't get much action in the short end. What I tried to set out is a few sort of generalized situations and the reaction that you're going to get in the curve. I've also done a couple of images of yield curve changes over time. If you do get a Reuters or anything like that, they're fantastic for being able to look at the way a yield curve changes and the implication of it. So I'll try and explain some of that in a minute. Ultimately, if you've got at least a basic idea of what it's telling you, then you can sort of relate that template to what's going on at any point in time. What I've done here is, and this is in terms of the down and up bit, this relates to price, not yield. So when you get in a growing economy, generally what you'll see is selling off in bonds, but you'll sell off the long end more because there's this switch. The short end can sell off, but unless rates are going to go up, the short end's not going to sell off that far because it limits how far it can go and dislocate with very short end rates. The long end can go and go and go. So this then creates movement in the yield curve. I should probably add an extra leg to this table and draw what the curve would do. But the whole idea here is if that sells off, then your yield curve would look like that. That selling off more, it would go to something like that. So it becomes steeper. Generally, a good thing. If you've got a shrinking economy, the short end's not likely to move a great deal. It might go up a bit, but unless rates are going to change, the short end's not going to move. The long end will rally. So what you then end up with is a yield curve that goes from that to something like that. So the long end rallies, brings down long end rates, and the curve flips like that. With rising rates, then it becomes more focused towards the short end. The short end drops fast, the long end doesn't necessarily move. Rates can move, or rates can rise, and not have that much impact on the long end. All it will do is effectively keep the long end the same. It might add 25 basis points to it, whereas the short end will start to price in the idea of more rate hikes. So you get a quicker move in the short end. So you just end up with a curve that goes from that to that. So it flattens out basically. I'll discuss flattening and steepening over time. The general way that, or whenever you do get a suggestion of flattening or steepening, they're termed as a bull flattening or bear, bull or bear. If it's a bull anything, think bull means the price of the bonds moving. So bonds are going up and the curve is then steepening or flattening. So you can be bull steepening or flattening, depends upon which end of the curve's moving or which end's moving more. You can be bear steepening or flattening, depending again on which end's moving more. Restrictive rates is where we are at the moment. So you get restrictive rates. What you will see is the 2-year, we're not there at the moment now, we were there. Rates becoming restrictive, the short end will continue to tick up as they continue to drift the rates up. The long end won't do a great deal on the basis that the rates are going up to try and limit economic growth. So you end up with the long end doesn't do all that much. Arguably it rallies slightly, but it doesn't do loads. Where I show the sort of movements in curves, it becomes a little bit more obvious. When you have a recession risk, what you end up with then is going and buying into the long end. The short end doesn't necessarily have to move unless the recession is brought on by rates. So it's actually probably down to unchanged. And then as you get a recession situation, then you get the buying of the long end as an alternative to stocks. The thing that we're in the throes of at the moment is the question of whether the recession or an economic downturn caused by inflation, whatever you want to call it or term it as, is solved by data or by rates, because they're the two solutions basically. And that would then impact the curve in different ways. I'll give you an example of what I mean.
Meaning like one is the input metric and the other one's the output metric. The rate's the input metric, the economy is the thing in the middle, the race is the thing that's trying to influence the economy, the output is the data about it, that the input metrics had an effect or not.
Yes, and so particularly also if you think about it from a yield curve perspective more so, the two ways that a curve can move is either rate related or economy related.
Yeah.
The solution to, the Fed's job is not to turn a curve from inverted to not, but the solution to an inverted curve is either lower rates or better or improved economy. So it's kind of, the outcome of the curve move relates to either one or the other. I'll try and give you an example. So what I've done is I've done 3 stages of this move, which basically goes through the extremity of the whole inflation situation. What you got throughout 2022 is, this is what the curve was looking like before. So that's what you call a normal looking yield curve. It's lower at the short end, it's higher at the long end, on the basis that over the long term, you need to get more return, more yield to compensate for the fact that inflation will erode the value of your money. There may be better alternatives. So in order to get 10-year bonds sold, you need to actually offer something decent to get them sold. At this point, beginning of March 2022, short end, this is super short end. So assume this is basically Fed rate there. It's on the 1-month rate. So that's down at 0.25. Rates are then perceived to be going up over the next year, but not in any dramatic fashion. And the economy is looking still all right. This was the whole idea that, well, inflation is transitory, we're going to come out of this and everything's looking pretty good. That remains the case into June 2022 on the basis that, well, inflation is there. It's not necessarily going away, but rates are rising. The economy is probably still going to be all right, although it starts to flatline. So on the longer end, it doesn't matter whether you're on a 2-year or a 10-year, you're getting virtually the same return on it, which suggests the perception that rates are going to continue to rise. And with rates rising, the economy is not going to do all that well, or it's certainly not, things are certainly not going to get any better. You get to September and the perception continues, but now what you're actually seeing is this steeper curve at the front, and it's actually getting higher. So this is the point then where you start getting an inverted curve, i.e. the 2-year is higher than the 10. That's theoretically the indication of a recession, or is at least the precursor to a recession. Quite the exact determination of a recession is always the hard bit on that one. So that gets you to September. Then you end up in March 23 with the idea that, well, basically the economy's still going nowhere. Rates are still going to continue to go higher, which they did. That was around about the peak. Well, sorry, they still went even higher than that. But in March, that was perception. They were going to get to about 5%. So what's happening here is this is showing you that basically the rates are getting driven up to counter inflation. The knock-on of that is that the economy is going to struggle in the countering of inflation, which roughly what the Fed kind of said.
And the reason why that short-term interest rates go up because there's an expectation that, the reason that yield curve goes up is that prices will go down, right?
Yes.
Curve goes up, price goes
yes.
down. Because people have an expectation that there will be an increase
in rates going forward, yeah.
But over the longer term, the negative outlook for the economy means that they don't expect that to be sustained. How's the
so
the differential of the curve?
So the idea here is that the expectation of higher rates is going to negatively affect the economy going forward.
Yeah.
So economic growth is not going to be so great in the future. Inflation is not going to be so great in the future. So you can buy a 10-year bond, which would cover your sort of inflation 10 years down the line without the growth being so high. Equally, if the economy is going to struggle, the reason to own equities becomes diminished. Yeah. So the best alternative is to go and buy a longer duration bond as a way of sort of keeping your money relatively safe. The short end is always going to be just completely linked to the Fed, particularly the very short here. That's basically whatever the Fed tells you it's going to be. Then as you go out over 6 months, that's then giving you the perception of, or the sort of view of where people think rates are going. Beyond that is then the sort of slightly longer term view. So you can still go out to 2 years and go, well, what this is basically saying at the beginning of March is that in the 2 years' time, rates will be lower. It's not a prediction necessarily of where rates will be in 2 years' time, but it's the fact that it's dipping down suggests that rates are likely to be lower compared to, say, in June 2022, the expectation is rates will be higher and quite a lot higher. So then as the year goes by, the expectation of higher rates catches up with, the actual higher rates catches up with the original expectation in June. This was kind of the peak of short duration steepness. Rates are going to go flying up, which they did. That was the sort of 75 basis point period. So what you then get from the March is further sense that, if I go back one, just to give you a sense of where you were in March, you were looking at about 3.7% yield on a 10-year in March 2023. As the year goes by, through June, down here, SEP, then DEC, what starts to happen then is the short end continues higher because the Fed keeps on raising rates. So what this does is it pulls the longer end up anyway. So whilst the flatness suggests that no one believes the economy is massively going to be improving, each additional rate hike is still going to drag the longer end rates up. Excuse me. So you start to then see that bit more. It starts getting dragged up through June. Come September, come September, the longer end has come up a lot further. So if you look at, say, the difference between even a 1 year, or even a 2 year, what's starting to happen is come September, you've got this bigger drop in the expectation of rates. So basically the longer end is starting to rise. This is an idea that, well, now people believe that effectively the Fed's actions are solving the problem. The economy can now grow, so the longer end of the curve starts to drift up. What you then get as you get towards the end of the year is the fears around a soft landing, i.e., are we actually going to get it? Until December 2020, until December 23, you still had the Fed not saying we're done on the rate cuts. So I'm just looking at the June 23 and the current. Sorry, that's the June 23. The June 23 is the purple. The orange one is where it was then going into January, I think, because you still got rates very, very high. That was the June, and then that's where you were in January, February, the orange line. So basically mirroring the December. So the idea of everything looking pretty good in September then starts to get rolled back down as you move through the rest of the year. So what you then end up with from there is December 23 is down here. Rates are going to go high, really, really inverted curve, perception that the economy could well struggle. And this is the whole thing about how do you solve an inverted curve? If the perception is recession's coming, there's two solutions to that. Either you avert a recession by cutting rates, or a recession is averted by natural causes, if you will. The economy improves and the long end rates start to rise on the basis that people start selling bonds, buying equity. So that would then pull the yield up on the long end as people then move to equities, which would be a good indication they believe the economy is sorted. I've not seen enough of these to say that this is consistent, but most of the ones that I've seen, you get the sell-off or the yields dropping in the short end as the Fed cuts rates, which in turn helps the data improve. So it's almost a case they've taken it so far that things have got bad to then pull it back, the sort of overextension, if you will. The overextension is necessary because all these things slightly lag each other. So they had to go further on the rates to hold inflation back, and then you've got to pull the rates back because you don't need to be quite so extreme in what you're doing if you don't want the economy to really struggle. That was kind of the perception in 2023, that possibly the Fed's gone a bit too far and the economy is really, really going to struggle. As you went through 2024, as the Fed started to talk out rate cuts, because you see the difference between 2023, the economy is going to struggle and rates are going to get cut pretty savagely. Come June, the economy starts to improve, and as the economy starts to improve throughout the beginning of this year, the perception is we perhaps don't need so many rate cuts, which is why it stays relatively flat at the top, and then you see it start to drop, but not as far. So the distance from top to bottom is far narrower in June, on the basis that, well, we're not going to get any cuts, but we don't need them. Once you start getting the cuts, October, you're into that idea of rates are going to get absolutely slashed. We're going 2%, if not less, and the economy is going to improve. Now you're in a situation where the perception is the economy is improving. Rates are perhaps not going to go quite as dramatically down as they were, but things are all looking all right. It's not going to take much for the curve to actually start to really sort of go back to normal here. You're not going to have to take too much improvement to see these rates start ticking up here, and it starts to look a bit more like that. Particularly if the idea is the Fed's still going to continue to cut rates throughout throughout a fair bit of next year. On current basis, that would take rates down to here. So you could almost have the curve stay as it is, and rates would go down there and it would look more normal again. So that's kind of the story of how these things start to change and what impacts the curve at any point in time.
The current is 1 month or 2 year? The current line.
So each dot along the curve is the yield at different durations. Okay. So from 1 month, 3, 4, 6, 1 year, 2 year, 3 year, 5 year, 7 year, 10 year. So that's a 10-year yield. That's a 2-year yield. And then that's current interest rate.
Okay.
Make sense?
Yeah.
So what that is showing you, at least if you look at the 210, that's a bit more back to normal. That's what you would expect to see. The 10-year should yield more. there's a lot more uncertainty over 10 years that you should get a better return for holding your money or for lending your money for that duration of time than you should for lending it for 2 years. But if the perception is the economy is not going to do very well, you don't want that much return because you more want safety, so you don't mind taking a small return, buying the 10-year bonds and rushing to buy 10-year bonds because it's better to own them than it is to own equities, because a 10-year bond that yields you 2% is far better than an equity that loses you 20%. So that's why people go that way. I did this for one of the guys the week before the election, actually, just a brief explainer of the sort of shifts that we went through from March 21, low rates, the idea of the economy is doing all right. 22, inflation is not transitory. You're expecting more rates, but you don't get this sort of huge pricing of inflation coming in. Sep 22, rates fly up, and then you start to get this inversion in the curve, particularly if you go 2 year. Usually whenever anybody talks about curve inversion, they predominantly mean the difference between 2 year and a 10 year. So if you're going to look at that, that's the easiest way to do it. It's not that easy if you just look at bond prices though, because the relationship between say a ZT and a ZN is not 1 for 1, and the number of basis points in a tick, if you will, it differs between the two. The US is better than Europe for it because the US prices them so that they have a relatively similar type of movement, as in the longer duration you go on the curve, the less tick increment there is. So the 30 years got no tick increment, it's just 30 seconds. The 10 years got halves, 5 years got quarters, and the 2 years got eighths. So they move roughly the same. And that sort of keeps them a little bit easier to understand when you try and compare the two of them. But with particularly looking at ladders, the European ones have got a lot more sort of, the long end swings more in the Europeans, they don't all move together. But the long end moving more in Europe is not necessarily indicative of, let's say the long end goes up, that doesn't necessarily mean that long end rates are falling faster, because you've got to gauge the relative movement between the two. Trickier to sort of see when you see on rates. Another thing to look at is the difference between, and this comes down to currencies. So a few people asked about the impact on currencies. This is then rate differentials. That's probably the biggest driver of currencies or currency prices, so euro, dollar, sterling, dollar, etc. Is the difference in rates and the difference in the perception of rates. So what this is showing you here, this is a US 2 year versus European or German 2 year. What you get throughout 2021 and 2022 is the idea that, the fact that the Fed starts raising interest rates quicker. They indicate the faster raises in rates, they start raising rates quickly, that creates this movement. The difference between the two widens. So now you're getting nearly 2.5% better return on a US 2 year than a German 2 year. In order to get hold of that, well, you go and buy US 2 years. To do that, you sell your euros, you sell your German 2 years, get your euros, sell them and buy dollars, and then buy US. So that's what you're seeing there. And that has a pretty good correlation to exchange rates. This is what you got throughout sort of 2022, or at least throughout the sort of real surge in the rates there. This is the US. What you started to get was the beginning of hikes getting priced in. Well, they said they were going to do it in March 2022. Soon as they start doing that, you then get, and to the point about how markets correlate with each other, bonds drop together. But as this goes down, and the way I always look at these is pick a low or an equivalent point, and then look at the relationship and the way it moves from that point. So the 2 years drop, 2 years in Germany drop. That's all reasonably similar. But if you look at the sort of scale of the drop, this has moved a lot further. It also then puts in another very significant leg on the downside. This was the drag down on the idea that the Fed's going to shift to 75 basis points. So the German 2 years get dragged down with it, even though they've only done that much, whereas the US from that same low has done that much further. So you just sort of see the relative difference between the two. The Germans get dragged back, but very, very quickly, if you look at them where things bounce to. So if you sort of look at that high before the breakdown, which is around about here, there. Very quickly, the Bund, or sorry, not the Bund, the Schatz gets back to it. The 2-year doesn't. It doesn't come back. It barely gets back much through those lows, whereas the German ones get straight back. So that's then what happens is the yield differential widens here because this drops faster, and then it continues to stay wide because the German one bounces quicker as well. So both are seeing higher rates here, but this is seeing higher rates quicker. On the bounce, this retains the higher rates, even though not quite as high. This loses it. Effectively, 6 months later, German 2-year yields are the same as they were at the beginning of the year, despite the fact that the US are much, much higher. And it's that plays into the currency side of things. So that's what you end up with. Through that period, you just get this steady sell-off in euro dollar as people just decide they want to get hold of dollars. It actually traded to parity in the July. That was sort of the real extreme of it when it traded to parity. Never seen that before. Well, in that at least.
Traded to parity?
Yeah. So $1 equals €1. Seen it against the pound. Euro sterling went to parity, I think, end of 2008. Usually sterling's stronger than the euro and the dollar, but it traded evens at the end of 2008. That then traded it in the July on the basis that come that July, the ECB hadn't even started raising rates. The Fed by that point had raised rates 50, 75 and said that they were going to do another 75, and the expectation was another 75, and the ECB then started to raise rates. So there's fair reason to want to own the US. What starts to happen though is the other factor in terms of the difference between the currency and the interest rate differential is the perception going forward, so the kind of rate of change. The Fed had already massively ramped up the speed of their hikes. Once you got down here in the sort of summer 2022, you then had just reason for the bounce on the basis that Europe is going to play catch up whilst the US can't keep on raising rates so quickly. So your rate of change then flips back to Europe, and that then turns this back up. It didn't go miles and miles and miles, and we're currently trading 05. So we've been up to about here, and we're now trading around here. So that's where we are now, roughly. Right, curves and equities then. There's a few different, I was just talking to Nick about this, that equities and yield curves have differing relationships dependent upon what's going on. One relationship that's worth understanding is what happens when you have this situation. So what you've got here, focus on the orange and the purple. From July, so this is June, July 2022, yeah, there's sort of big ramp up in rates. But what you started to see was a situation where the 2-year rates are going up, the 10 years are not. This is that whole perception that the economy is struggling. So when that happens, rates are going down, the economy's struggling, the equities start to get weaker and weaker. That's where you get the inversion comes in. So that was that period there where you start to see these two, because typically you'd expect the 10-year, the purple, to stay above the 2. You get to a point here where the inversion becomes very clear. The 10 years down here, the 2 years up here. That's your flip. Once you get that inversion, the perception is this is going to be bad for the economy. So what you've got down here then is the S&P in green. Once you get the inversion, the S&P had already sold off from here as well, so it's not the greatest indicator in the sense that you don't then get, oh, it's inverted, massive sell-off. Often the inversion comes, the equities have already been pricing this in. Like I say, when you get the focus going towards the 2-year and rates, the equities are the ones that they'll go with the 2-year on that. You get that type of movement. What you then started to get through 2023 was then this additional steepening, additional flattening inversion. Then you started to get this quick steepening back out. Once you started to get that, you started to get a sense of, to a degree, stability. But it depends on how that stability comes about. This is the inversion of the curve. Similar kind of idea as that previous concept, that this is a 10 and this is a 2. That what you start to get is the 2-year yields ramping up, very similar to that European one, that what you end up with is the 2 years don't bounce as much and put in these bigger drops. The 10 years do. So when the 10 years start bouncing back, you start getting it here and here. This is the beginning of the inversion now, that you've had the sell-off, and now on any bounces back, the 10 years starts to rally more than the 2 year, which is what starts to get the inversion really going. That any chance to bounce, people start going 10 year. So that was kind of the way that you could play it, that if once you started to get that inverted curve, that 2 years are yielding higher than 10s, any chance to buy the 10s, you can go for it. Which we then continue to see for much of the rest of the year. Whilst you still got a generalized sell-off in bonds on the basis of rates going higher and higher, any time that the 2 year sort of stalls out and stops at low, the 10 year bounces much more significantly. So the 2 year then starts to break new lows, the 10 year doesn't. So now you're in a situation where that acceleration of rate cuts really starts coming through. The 2 year keeps going down, the 10 year doesn't. And the 10 year starts to then bid up. Once you got the SVB crisis, which was the next part of it, this is where you then start to see the 10 year selling off now. So this is then the other part of the re-steepening of the curve. So you get the flattening to inversion, which is where it flips over to the recession. Post SVB, then you got, this is the SVB crisis here. The 10 year then really sells off. This was the beginning of the idea that the economy might be improving again. The 10 year gets absolutely hammered. The 2 year drops, but the idea of rate hikes is starting to diminish, or at least they're becoming slower. So then you start to see the flip over. So what you end up with there then, this was the post SVB re-steepening. Everything starts looking all a little bit better. And then this is what happens in the S&P. You then get the flip back and you get the re-flattening. But that was a re-flattening from the short end, the rate hikes are still coming. What we then ended up here is what you call, well, it's another steepening, but it's a steepening from the back. So this is a bear steepening move, whereby the bonds are selling off, but the long end's really selling off. What this does is it affects companies' ability to finance. Reason being, most corporate debt is around about 7 to 8 years duration. So corporate debt is priced off of a 10-year bond more so than it is off short end bonds. So if 10-year or longer end yields start rallying, or yields start rallying, that then has this big knock on that borrowing costs suddenly start to ramp up very, very quickly. That actually has a negative impact on the equities. Effectively, companies can't handle rates going up that quickly. So then you end up with a situation that you go back to an inverted curve, but then the equities rally. The equities rally on the basis that you're going back to the inverted curve, but conditions are improving in that the borrowing costs are not ramping up. So then as you get the 10-year rates start to fall back a bit relatively, then you can get that rally that starts to come in. And then we've seen continuation of that this year. So far this year, I don't know if I've got the curve up at the moment, no. So far this year, we've gone from about a minus 0.5. We're trading at positive 0.2 now. So the curve's completely re-steepened back to what you would normally look for. That's your indication that things have improved. We've also had this very, very recent action since the election. That what you've had since the election is initially the steepening from the back of the curve, the selling the long end on the basis that Trump's policies are going to be inflationary. He is going to borrow more money. So everyone sells off the long end. Sorry, I put steepening for everything here. That's not, it was steepening, sorry. So the long end sells off. So long end rates go up, which is what happens here. So that's then a bear steepening move. Long end sells off, pushes the long end rates up. Then what you end up with is as they start to bounce back, the short end rates then start to rise. So this then flattens the curve out because the difference between the short end and the long end will then come back in line. So then you start seeing the short end selling off on the idea that, well, if we're going to get a greater degree of inflation, if the economy is going to improve that greatly, we're going to get less rate cuts, which is what starts to happen in the short end. Since CPI, we've now gone back to the pre-election or post-election idea that if things are going to get better, and even with that CPI not suggesting rate hikes, you can then sell the long end and the short end stays up, and you're back to that type of steepening. Steepening from the back end of the curve is more of an indication of an improving economy. So this is seen as reasonably positive, which is what's taken everything up here. So there we go. Fair bit to cover on bonds. Hopefully people, I think it's one of these things, you've got to just watch these types of things over time and you start to sort of pick up, all right, this has happened, curve's done this, or you've seen 2-year bonds not going down, or they're only going up, whatever it is. And you can then sort of put the 2 and 2 together. I don't think it's the easiest thing to just go, oh yeah, look, this happens, that happens. It's one of these things you've got to just have a watch, work it out over time.
Is it just something to just keep an eye on? Just to have an understanding of what's going on with interest?
Yeah, it's something, keep your eyes on, keep a watch of it. It's more something that really starts to play out when you're getting more dramatic movements in rates. Okay. What we'll probably go back to relatively soon, assuming that things don't suddenly get worse. If inflation keeps ticking up the rest of the year, then that whole idea starts to come back in play and you start to get the whole idea of, excuse me, the short end will then start to tick down on the basis that we might see rates going back up, and you'll start to see that play of the curve then going back and sort of going back to an inverted curve on the basis that inflation is ticking back up. This is going to be a big problem for the economy. You could then start seeing that drag down on equities. So it is one of those kind of, you sort of keep a track on how things are moving. Like I said, I think the easiest way is to look at the 210 spread and look at how the 210 spread has changed in relation to which bond is moving it. If it's gone steeper, is that because the 10 years selling off, or is it because the 2 years bidding up? Because that's the way it would get steeper effectively. So if 2 years going up, it suggests rate cuts, probably because the economy's not doing well. If it's the 10-year going down, then it suggests the economy's doing all right, and you'd see equities going up on it. Right, final thing I thought I'd just touch on really, really briefly. Europe's really good for this because your life is made a lot easier by the fact that Europe is one interest rate for everybody. So any difference between, say, a Bund and a BTP, theoretically, is the difference in creditworthiness. Yes, there's the economic prospects of Germany compared to Italy, but a large part of it is creditworthiness as well, which then means that you can play effectively a simple credit spread. What you see, and we saw this throughout 2018, we also saw European elections recently, is that when you start to get fears around one country underperforming in Europe, defaulting, exiting Europe is the kind of go-to sort of existential problem with it. When you get these types of situations, what you'll get is this kind of trickle-down effect. To start with, you'll see the spread widen. So let's say in this example, oats to buns, that will start to widen. If this is perceived as a more and more significant thing, then you'll start to see the euro selling off and euro stocks selling off on the basis that this is now actually a broader credit problem, not just simply France isn't doing so well type situation. I'll give you a very quick example of it. This was the European elections. When you had the European elections, you got this huge jump in the difference or the spread between BTPs, bunds and oats. So that's gone from 0.5% to 0.8% in a matter of like a few days. Nothing's fundamentally changed in Europe. So this is clearly just a perception of France is not doing as well as Germany anymore, or is a greater credit risk than Germany. Sell oats, buy buns. So the S&P just hit some stops. Yeah, it's starting to look a little bit ropey now, isn't it, the S&P?
Yeah, that's true.
Still short NASDAQ?
Short, no, I got out, I entered again today.
Fair enough. Yeah, that S&P.
Still not Bitcoin, but on the NASDAQ. The opposite of Bitcoin on the NASDAQ.
There you go. Yeah, Bitcoin's getting hammered as well now. That's down below 90.
It's a huge move on Bitcoin.
Yeah. It feels like this is the kind of flush out of all of that recent move. Be worried if the S&P breaks 86 now. I think that could be.
Yeah,
that's the big one. But yeah, it's got a kind of liquidation feel about it that sort of zipped through 6,000. The way it just shot down there. Yeah, I think if this doesn't get back up there pretty quick,
I think
it could be a bit of a problem. There you go. Right, yeah, so that's what you'll end up with. The way it will play out, this was the one on that election. So this was a pretty straightforward trade. So it's this highlighted area. Often you get situations with these types of trades where it is not as straight as you buy one, you sell the other. What you ended up with was on that European election, the oats got hammered for a couple of days. During that period, the bunds didn't do a great deal. It's a really common type thing. The oats get dragged down and the bunds kind of follow it. And then there's this kind of realization, well, this is a difference between France and Germany now. So you don't want to be short the bunds, you want to be long bunds here. Once the oats start to bounce a little bit, they're still worse off. And that's then the beginning of the buy in the bunds. So you have time a lot of the time with these types of things that the one that's immediately impacted, the oats, get hammered. They get hammered as soon as they start to stabilize, then the buy comes into the bund rather than it just being such a straightforward move. Yeah, if you're doing that as a spread, it's fine. You sell the oats and buy the bunds. You go onside oats, bunds go nowhere. Then the bund starts to rally as the oat comes back. But essentially you go from onside and a scratch to massively onside and back to scratch. So you'll see your one side of it will perform and the other side won't. From a day trading perspective, it's a much easier trade to wait for the bund to start to move up and then play that. You know that that trade's on because it's a fear over Europe. Then what you start to get is the French election comes in. Once you get that French election, then you start to see the reversal of it as well. Initially, not seen as great, and you get the sell-off in the French bonds, and then you start to see the rally back, whereas the German ones sell straight off and then stabilise. But this becomes the kind of solving of the problem. That French election, whilst it seemed bad, you've got to bear in mind how far the French bonds have got pushed down on this already, and that was then the sort of point of reversal. But you got the same kind of thing. As soon as you started to get that deterioration from the European elections, this is where you then start to get it knocked onto the Euro stocks. So you get this kind of lagged move that is sell off the oats, buy the bunds, and then people sell off the Euro stocks on the basis of this is quite a serious problem. So one to watch out for in Europe in particular. Europe's good for it. Because like I said, there's no real reason to sort of view it in any other way. It's just a straight, it's bad for Europe. And if those spreads start to suddenly widen, you then get the knock onto Euro stocks and then the knock onto the Euro. So there we go. Pretty in-depth. Hopefully everyone's taken something from it. If not, just baffled. I hope I've tried to explain stuff reasonably well as well. Any questions, throw them in. I will try and answer them on Monday. I think, if nothing else, just make sure you look at, look at a 2-year and a 10-year, see how they move. You just try and sort of piece together the relationships between different markets. It's something that over time you will just work out and you'll naturally start to see how these things sort of tally up with each other. Right, I will wrap it up there, guys. It's been a long day. I will see you all tomorrow. Last thing, order flow exercise tomorrow. So tomorrow's the catch up on the last day of order flow. Dead simple. I can post a PDF, but dead straight and simple. Come in tomorrow, turn all your charts off and trade with no charts. Real simple. Best thing you can do if you're going to do that, pick a point to start and draw your chart from there. If you can draw your chart, you really pick up on where the market's sort of stopping and starting. Don't do 3 or 4 markets there, you'll never keep up. But if you just draw where it trades as you're trading it, the sense of what goes on at those points is really, really clear. You'll be surprised at how well you can draw a chart and then it matches to the real one. So if anyone wants to draw it and send it in, feel free, and I'll see how closely it matches a real chart. But you'd be surprised at how good you are at it. No one thinks they will be. If you just watch and make a conscious effort to sort of, market trades down, where does it stop? Where does it bounce? Where does it stop? Where does it bounce? You're not trying to draw every little tick, 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 tick. All you're trying to do is get a gauge as to where exactly it sticks along the way. You'd be surprised at how good you are at it. You also really notice the way the order flow works at those different points. So let's say you've traded down, you see it stick, you know what it does, it bounces back, it goes back there. You become much better again. I remember what it did last time. Does it do the same this time, and what's the implication of that? So have a go at it. Let me know how you get on. Love to see any of the drawings anyone manages to do. I'll see you all tomorrow.